My friend, something big happened last week. The Federal Reserve suddenly dropped a hawkish bomb that completely stunned the market. Even scarier, a multi-trillion-dollar liquidity alarm has started flashing red. A giant gray rhino is charging full speed toward the market, and most investors are still asleep. You might be wondering, what gray rhino? Will my money be affected? Don't worry, today I'll explain the storm in the simplest way possible and show you how to prepare. Hi everyone, I'm Daryl Hart with 25 years of real market experience. If you don't want to be caught swimming naked when this storm hits, remember to like and subscribe. Let's dive in. Let's start with three key numbers straight from the Fed's latest data. When I saw them, I literally gasped. $2.8 trillion. That's the current reserve balance in the US banking system, the lowest since 2020. You might think, $2.8 trillion still sounds like a lot, why panic? Wrong. Dead wrong. You have to understand, this reserve balance is the lifeblood of the stock market. Every dollar circulating in the market, every dollar in your account traces back to it. And now that fuel is evaporating at an alarming rate. I've said it many times before, $3 trillion is the psychological threshold. Once reserves drop below that, it means liquidity is tightening at the margins. And now, it's already below. The next danger line is $2.5 trillion, and once we hit that, what could happen? The kind of banking crisis we saw in March 2023 could happen again. Remember Silicon Valley Bank's collapse? 3.75% to 4.00%. That's the Fed's new federal funds rate range. On paper, yes, the Fed did cut rates by 25 basis points. The market should have celebrated, right? But then Powell said, far from it. Those three words froze the market instantly. And the scariest part? That phrase wasn't off the cuff, it was written in his prepared remarks. You know what that means? It was a planned strategy. The Fed deliberately wanted to crush excessive rate cut expectations. And what does high interest mean? High cost. Borrowing becomes expensive, profit outlooks shrink, especially for those cash-burning tech giants. It's a brutal hit. One-third. Meta's free cash flow in Q3 plunged by one-third year-over-year. When that number dropped, Wall Street was shocked. We're talking about a trillion-dollar company here. Even a behemoth like Meta can't escape the market's wrath when cash flow can't keep up with its massive AI spending. The stock tanked immediately, a clear sign. Put those three numbers together, and you see the frightening truth. The rules of the market game are changing, and most investors haven't realized it yet. Last week's trading action can only be described as bizarre. If you looked closely, you'd notice three clear signals, all pointing to one thing: danger is coming. Remember last Monday? The market went absolutely nuts. Apple, Microsoft, Google, Amazon, Meta, Nvidia, Tesla, the Magnificent Seven, all surged together. That's extremely rare. It's hard enough to make one elephant dance, but getting seven to do ballet in sync? Practically impossible. In the past, these seven stocks rotated, never all rising together. But that day, they moved in perfect harmony. Yet the celebration didn't last. After the Fed meeting, everything flipped. Except for Amazon, the other giants all opened high and closed low. Nvidia plunged nearly 10% in a single day. Tesla fell sharply, Apple tanked. The scene was brutal. Then something weird happened. Small cap stocks started surging. Quantum computing names soared, data center stocks shined, and rocket stocks went parabolic. What does that tell us? Money is rotating violently. Funds are rushing out of safe, predictable blue chips and into high-risk, high-imagination small caps. That's dangerous because history shows when money rotates this frantically, it often signals a major market turning point. Even worse, the rules have changed completely. Last week, the four AI kings, Amazon, Microsoft, Google, and Meta all held earnings calls boldly declaring, "We're going all in on AI." Sound inspiring, right? But the market's reaction? Worlds apart. Amazon soared 9.5% in a single day, lifting the entire index. Why? Because AWS, its cloud business, directly converts AI spending into real revenue. The ROI is visible and immediate. The business model couldn't be clearer. Microsoft has a $400 billion backlog. Google sits on $155 billion in deferred orders, both backed by strong cash cows. But Meta? Its stock tanked. Why? Because its free cash flow dropped by one-third. And it has a fatal weakness: no cloud business. Its AI spending looks more like an internal cost center with no revenue offset. Long payback, heavy burden. And don't even mention the money pit that is the metaverse. The market's done buying stories. You say you're investing in AI? Fine, show me the money. Show me cash flow. Show me a clear profit path. Otherwise, even if you're a trillion-dollar giant, you're getting dumped. And here's a detail most missed. On the last trading day of October, the market acted weird again. On one hand, fund managers were doing the usual window dressing, rushing to buy strong-performing stocks at month-end so their reports look good. Look, I hold all the winners. On the other hand, institutions that made big profits in October were locking them in, selling winners, rebalancing portfolios. Buyers and sellers clashed hard. That's why the market whipsawed violently. In that final half-hour plunge, it was big money exiting, unwilling to risk weekend and month-end exposure. Put all that together and you'll see this isn't a normal pullback. It's a warning. Many think this is just a routine correction. Prices went up, now they're cooling. No big deal. Huge mistake. This isn't a correction, it's a deep revaluation. The entire market's logic is shifting. Before, markets love stories, growth, potential, AI dreams. Say you're doing AI, and your stock would moon, real results be damned. Investors bought dreams. Now, the market's cold and ruthless. It wants cash flow, viable business models, and clear profit paths. Your AI spending must have a visible payoff or you're out. Meta's the perfect example. It shows that in this AI boom, the market rewards not the loudest slogan, but the healthiest business model. If massive spending isn't backed by real profits and strong cash flow, even a once great company gets punished. And the Fed's attitude? Totally changed. Before, everyone thought, if the economy weakens, the Fed will cut rates and flood the market with liquidity. Stocks will rise. Now the Fed's saying, the economy's too strong. Q3 GDP growth may hit 4%. The job market's on fire. Consumer spending's robust. Why should I rush to cut rates and fuel inflation? See the logic flip? Good economy equals lower rate cuts equals higher for longer rates equals expensive borrowing equals valuation pressure. That's the new logic. And those clinging to the old one are paying dearly for it. The scariest issue? Liquidity. Reserves dropped from $3 trillion to $2.8 trillion. Less money in the system. What happens when there's less money? Investors sell the riskiest, most overvalued assets, speculative AI stocks, and profitable tech crypto. That's why Nasdaq's been sliding and crypto's bleeding, not because the assets themselves broke, but because there's not enough money left. Tight liquidity plus high rates plus valuation resets equals a perfect storm. And this storm is only just beginning. So what do we do? Sell everything and hide? Or stay all in and gamble? Here's the smarter way, a survival rule I've built over 25 years. Remember, staying alive always comes first. But survival alone isn't enough, you have to seize opportunity too. You need a portfolio that can defend and attack. Think of your portfolio as a fortress. It needs a solid foundation to withstand storms, but also flexible towers to strike when chances arise. Your core holdings should make up 60 to 70% or more of your assets. That money belongs in battle-tested leaders, companies with stable business models, healthy balance sheets, and clear AI moats. In today's market, two main tracks dominate: AI infrastructure and AI applications. AI infrastructure is like selling weapons in a gold rush. As long as the AI arms race continues, chipmakers like NVIDIA, AMD, and Broadcom will keep winning. Look at Qualcomm, one new AI chip launch, and the stock jumped over 10%. Proof enough. AI applications are the battlefield itself: Microsoft Azure, Google Cloud, Amazon AWS, where AI models are trained and deployed. Their CapEx trends are the industry's compass. Anchor your core capital here in the real winners. You may not get rich overnight, but you'll sleep well and avoid panic selling at bottoms. A solid core gives you footing and strength to counterattack later. Then comes your satellite holdings, your offensive force. This 20 to 30% portion is for growth and flexibility. It's where you chase asymmetric upside, small bets, big potential. Use it to target temporarily beaten down sectors with long-term promise, data centers, space tech, quantum computing. Many of these just had strong rebounds. Pick your spots wisely. Yes, it's higher risk, but limited downside, huge upside. A few winners here can transform your returns. The key is dynamic rebalancing. The market breathes, your portfolio should too. When euphoria inflates your high-risk satellite holdings, sell them and reinforce your core. Lock in profits. When panic crashes your satellites but your core holds steady, trim the core and buy the dip. Launch a counterattack. That's how you conquer greed and fear. Buy low, sell high, instead of chasing trends. Look back at last week. Many small caps crashed early Monday, then rebounded sharply. If you panic sold, you missed out. But if you followed a core satellite strategy, you stayed calm. The base was intact. The tower was just shaking. That's your chance to add, turning others' fear into your gain. And one crucial point, from now on, when you read earnings reports, focus on free cash flow. Forget the revenue hype and AI storytelling. Ask three simple questions. Can this company's AI spending turn into real income? Does it have a stable cash cow business? Is its business model clear? If any answer is fuzzy, be careful. Meta is the cautionary tale. Even trillion-dollar giants can't defy weak cash flow forever. This reminds me of 2018. That year, the Fed was also hiking and tightening liquidity. Everyone said, this time is different. Bull market forever, right? Wrong. By Q4, Nasdaq fell 17%, the S&P 14%. Many investors got wiped out, some never came back. But those who held strong fundamentals not only survived, they thrived in 2019's rebound, recouping losses and then some. History doesn't repeat, but it sure rhymes. When liquidity tightens and rates stay high, the market purges the excess. Overvalued, profitless names collapse. True cash generators rise to the top. The 2023 banking crisis taught the same lesson. Remember? SVB collapsed in 48 hours. First Republic followed. Panic everywhere. The trigger? A liquidity squeeze, reserves draining too fast. We're approaching that danger zone again. Reserves at $2.8 trillion, next stop $2.50. If we fall that far, history suggests it won't be pretty. Today's market is like a giant ship sailing into a storm. Veteran captains can already feel it, the wind is rising. That $2.8 trillion gray rhino still seems distant, lumbering slowly. But it's moving and accelerating. Once it charges, the impact will be devastating. Are you ready? Can your portfolio survive what's coming? Mid-November, new inflation data. If inflation beats expectations, the Fed may turn more hawkish, killing hopes for a December rate cut. How will the market react? Late November, Thanksgiving. Liquidity tends to shift sharply around the holiday. Historically, volatility spikes. Will this year be any different? Early December, the next Fed meeting. Will they pause or slow the cuts? That decision will define Q1 2020 SIX's direction. Each of these could trigger the gray rhino's full charge. I'll break them down one by one in my next videos, when to defend, when to attack. If you don't want to miss it, subscribe and hit the bell. Let's end with today's three key takeaways. $1 $2.8 trillion is a yellow alert, $2.5 trillion is red. Watch liquidity, it's life or death for the market. 2. Cash flow is the new gold standard. Ignore pretty AI stories, follow real profits. Avoid companies that can't show results. 3. Use the core satellite strategy. Protect your capital with core holdings. Hunt alpha with satellites. Rebalance smartly and beat human emotion. This market turmoil isn't random. It's the product of tightening liquidity, high rates, and value repricing. These forces are reshaping the financial world. In times like this, rationality is your superpower. Staying in the game matters more than timing perfection. Those who panic and exit miss the best opportunities. Those who get greedy and overextend face the worst pain. True winners are those who balance fear and greed, who respect the market without being ruled by it, who have strategy, discipline, and patience. I'm Daryl Hart. If this helped you, please like, share, and let more people see it. See you in the next video. Invest wisely and stay calm. Remember, in the raging waves of the market, the survivors are always the ones best prepared. And don't forget the 3 steps. Like this video, subscribe for more strategies. Turn on notifications so you don't miss any crucial signal.